603. Hi, everybody. I appreciate everyone's wait and patience. We're going to start, and this will be recorded. I'm joined by our special guests, Troy Eckard and Amanda. Amanda is a little bit shy tonight, but she might pop up. It's okay. Just a little bit of housekeeping before we begin. If you guys, hi, Amanda. If you guys can keep the questions not in the chat, but in the Q&A, so I can mark them and go through them, and I'll ask questions. Troy's a very fast talker, and I'll try to interject as much as I can. But I'm very excited to be, joined by Troy and Amanda tonight, and by everyone tonight. Thanks for coming out at 6 p.m. Pacific. I'm not sure if it's later for you in the East Coast or Central. It's one of the asset classes I think a lot of investors have been talking to us about. It's been in the news, oil and gas. It's something that I track a lot because I'm also in Bitcoin mining and we use energy a lot. And we did a drilling investment last year as well. And we're looking to do a little bit more in this category. So wanted to bring in one of the leading experts and one of the best informed people I know in oil and gas. Troy, thanks for coming.
Yeah, no problem. Thanks for inviting me. I'm looking forward to sharing some very simplistic understandings of our business and being able to answer questions and try to help everyone get a little better handle on what's going on in domestic oil and gas here in the U.S. So I look forward to it.
And so Troy will be doing a little presentation, and as you guys have any questions, add in the Q&A. We'll try to have a Q&A at the end, and we'll probably wrap up at the end of the hour.
All right, good. I'm going to load this up and then we'll get started. Just so everyone knows, I naturally talk fast. I had brothers and sisters, and if you didn't talk fast and grab the last biscuit, you went hungry and never got hurt. So it's a natural instinct for me. What I'd like to do is I'd like to just start off with just a very simple presentation. I've asked Eng to interrupt me when he has clarity questions on your behalf. It is 8 o'clock here in Texas. I start off in the mornings about 5 a.m. with a half a cup of coffee, and I sound like I've been on crack cocaine for a month because I go so fast. So the good thing is this is late at night and I'm kind of running low on energy, so maybe I can keep it at a second gear pace. So let's get started. First off and foremost, I'm Troy Eckard. I'm the CEO and manager of Eckard Enterprises. We're a private family energy company here in the Allen, Texas, Dallas-Fort Worth area. I started back in 1985. I was taking economics and finance in college. My family did not have a lot of money. So like most entrepreneurs, the direction I took was based upon good fortune, kind of understanding numbers, really being in tune with working with sophisticated individuals who ran their own businesses, had their own investment strategies, and just by pure happenstance, I ended up in the oil and gas energy market. Started my career as an investment broker, worked for a small company, realized they were good people. They just weren't very successful at finding economic and profitable oil and gas. So as it turned out, about 8 or 9 years later, I had my own investment firm. I also created my own oil company, and I began to drill oil and gas wells, buy pipelines, invest in several different sectors in the oil and gas industry, in which I would go in and acquire and partner with other large oil companies, and then invite high net worth investors like yourself to participate in LLCs or partnerships or joint ventures. My background is pretty extensive. This will be the 37th year I've been in oil and gas. I don't feel that old, but I started when I was 20, and I can tell you that for most of you who are very much involved in the technology industry, all the things that have happened with the .com and all the technologies out there today, the same path has been taking place in the oil and gas sector, where the old movies that you saw where a guy would drill a well and throw chain and you'd see him out on the rig and oil flying everywhere. Well, that's kind of how it was in the 1980s. I mean, it was pretty antiquated. By all imagination, it was a very antiquated industry. Today, in 2022, they actually have drilling rigs that are drilled almost all by computer. You've got a guy sitting inside of a closed-in room looking with joysticks and using hand controls like you would on a video game. They use triangulation with satellites with chips behind the drill bit, drilling 2-3 miles in the ground, guiding that drill bit within inches of accuracy. And so the industry that I've been in, that you're now getting information about, has evolved from antiquated horse and buggy to modern technology. And it's been quite an evolution that I've seen over my career, which is exactly what brings us to today. The US has been very fortunate that because of technology, over the last 12 years, we became and have been the #1 crude oil producer in the world, passing both Russia and Saudi Arabia. How do we do that? Technology. Oil and gas is always there. It's always trapped geologically under the ground. The question is it economical to recover? And do you have the technology to do it? We had the oil and gas. We knew where it was. We didn't have the technology. I'll just give you just a small example to show you what our upside battle has been as an oil industry. One well in Saudi Arabia can make 100,000 barrels a day and produce 10, 20 years. They're sitting on an ocean of oil. So they might have 100 wells producing their 10 million barrels. We have more like 90,000 wells because the average well in the US has been historically producing 15 barrels a day. That has changed. What has changed is that we now have found huge buried geological features that have just billions of barrels of oil, trillions of cubic feet of gas. We just have to drill more wells than Saudi Arabia, but we probably have darn near as much oil and gas in place as Saudi Arabia in today's economic calculations. So as somebody who's been in the industry for almost 4 decades, I get the ability to share with you kind of what I see as the evolution of where you and I as private investors can now invest our money safely with low risk attributes and do it based on the most advanced technology. So I'm going to explain a little bit about what we do. And the reason why Eng and I have been talking, it's about buying mineral rights. Now, most of you probably have no clue, or at least you might guess what a mineral right is. I'm going to use a few pictures and analogies to kind of explain what a mineral right is and how we make money investing in mineral rights and why it's something that may or may not fit what you're doing. First off, in the US, we're probably the only country in the world that actually allows private citizens to own the mineral rights or the natural resources below the surface. The US, back in the land grant days, when you were given the right to secure your piece of property, go west, young man, put your stake in the ground, get your square mile, settle. You didn't know it at the time, but you were given 3 rights. You were given air rights, everything above the surface, not connected to the surface, above your property. The surface rights, anything attached to the surface, your farm, your ranch, your building. And then the mineral rights, which is everything below the ground, not counting water. So with those 3 rights, over the last couple of 100 years, it has evolved where now mineral owners have become a separate asset class. Surface owners can be a separate asset class, and air rights are a separate asset class. So I physically can own a piece of land, sell off my surface right or my mineral rights, sell off my air rights, and retain my surface rights, or any one of the combination of 3. It's real property. They're deeded, they're recorded in the courthouse. So many of you don't realize that your house you're in now, your building you're in, when you have a Colorado mountain home, you own the mineral rights underneath that property unless specifically it's been carved out of your deed and title. The problem is you probably don't have any natural resources that are economically viable to recover. So owning it's great, having some value underneath it, it's a totally different story, okay? So now we're going to talk about what exactly mineral right is in definition. And it's just for you to understand, which is it is a right. Is a physical piece of real estate. It's classified by the IRS as real property. You can use it in a 1031 tax exchange. You can invest in it in your regular investment account. You can also invest in it in self-directed IRA. So pretty much mineral rights are just like a piece of real estate. You can do the same thing in mineral rights as you do a normal traditional piece of real estate, whether it be a house or apartment complex or commercial piece of property. The main thing to keep in mind is everything below the surface, because everything above the surface is a completely separate asset class. Let me put it, and I'm going to choose a couple of slides to show you in real estate terminology the best way I can, the correlation between mineral rights and your normal real estate investments. A mineral owner is essentially, we're the landlord. When Exxon comes out and they want to drill a well on property where I happen to be the surface owner and I own the mineral rights, technically, as the mineral owner, I own 100% of all the natural resources below the ground. The problem is I don't have $10 million to go drill a well. I don't want to take the risk. I don't have the money. Exxon has the money. So Exxon comes to me and says, look, Mr. Mineral Owner, I'd like to lease your minerals. By leasing it, I'm going to assume 100% of the risk, the cost, the liability, the environment. I'm going to take 100% of the risk. I'm going to go drill the wells. And if I do, we're going to have a financial agreement. Well, what's the agreement, Exxon? I'm going to get you to retain 15 to 25% of all future income from every barrel of oil and all the gas that I extract, not only from one well, but from every well, no matter how deep it is, how long it produces. But for as long as Exxon, in this example, is extracting oil and gas, I get paid 15 to 25% of the profit without any expenses. That's why they call it a royalty payment, because like the Queen of England doesn't do a thing, but she gets royalty off all the Queen's property. All right. And this is an example so you can visually see what I'm talking about. So in this case, we've got vertical buildings. You go out and see a high rise or condominium project. We all get that. I need to build it. I need to entitle it. I got to hire property management. I got to rent it out. I can sell the condos. I can keep it. It could be a hotel. It could be a self-storage. The same thing happens under the ground. The only difference is I have a main company, a main tenant, which is the oil company. That oil company has agreed to lease it, to spend all the money, kind of like a triple net lease. And I just simply get 15 to 25% of the revenue free because it's all mine in the first place. And that's just how oil and gas mineral leasing works. You pay all the bills, you take all the risk, and you give me 15 to 25% of the money. I love it. It's the most passive income generating asset I can own. Now, when I take a look at some of the comparisons between real estate and mineral rights, the actual fact is what? There's not any property tax, at least in the state of Oklahoma where we focus. Texas does have property tax on mineral rights. I have no expenses. Accounting fees are simple. It's 12 revenue checks, one per month, and a 1099 at the end of the year. So I can't say it doesn't have any accounting, but it only has you depositing checks and giving a 1099 to your tax preparer, right? We don't have any insurance or maintenance. We have zero risk, zero liability, zero environmental. We're the top of the food chain in the oil and gas industry. Why? Exxon, Chevron, Marathon, any major oil company cannot drill a single well on private land in this country until they've negotiated a lease with you and I, private mineral owners. At that point in time, no matter whether they file bankruptcy, oil prices are high or low, the first thing they do when they sell the oil and gas each month, they must take that revenue in at the end of the month, put it into an account, and the percentage of royalty goes into the royalty distribution account, meaning that it's not their money. So they set our royalty, our income aside. They take the net remaining amount, anywhere from whatever, 85 to 75%. And that's what they have to pay all their bills, expenses, costs, rework, abandonment from the remaining interest that they own. We truly are in 100% top of the food chain position. Now, there's two things, and Eng and I talked about this a little bit. There's two ways that you can look at investing in oil and gas for the most part when it comes to what we call the upstream. So think about a river. Upstream means in the oil and gas sector, there's three sectors. There's upstream, midstream, and downstream. Upstream is everything that's connected to the origin of the oil and gas that's being extracted. The drilling, the seismic, the leasing, the mineral acquisitions. So it's all the very beginning upstream, like the beginning of a river. That requires a lease document, and somebody that's willing to go buy the lease and drill the well. So we are the landlord, we're the mineral owners. The tenant is the oil and gas company. We sign a lease agreement, a rental agreement, a royalty agreement. They all get signed. And guess what? We go to the beach. We go run our real estate portfolio. We go invest in cryptocurrency. And I've got major billion-dollar oil companies that decide they're going to go spend all the money and do all the work. I like that kind of building. I like that kind of real estate. I literally sign a lease, get paid, and go on about my business waiting for my check to show up. Now, in the case of the United States, there's about 2.43 billion acres in the US. Every single acre has a mineral right below it. Where I live in Dallas, Fort Worth, the first big shale oil and gas field was discovered back in the 1990s. Homeowners associations, commercial buildings, hotels, shopping centers realized when they developed the property, they still had the mineral rights. So you had big companies like Chesapeake and Chevron and Exxon and Chief Oil came in, found locations, empty lots, and they were drilling horizontal wells underneath subdivisions and shopping centers 2 miles below the ground. And you've got homeowners here that have been getting gas checks for 25 years, 20 plus years, because they owned the mineral rights, had no clue they did. So because of the vast amount of minerals in this country that's available, You've got about 20 million people in the US who get a check every month from the sale of oil and gas for minerals that they own. It's estimated today it's about a $500 billion industry. Let me give you the secret. It wasn't available 10 years ago. 10 years ago, you had to literally count on a single 7.5-inch vertical well being drilled, kind of like throwing a dart at a dartboard with a bandana across your eyes. If you bought the minerals, you had to hope that the well was successful, or otherwise your minerals became pretty much worthless or significant loss in value. Today, which I'm about to show you, the drilling isn't risky. I don't really have to have a geologist like a weatherman telling me what it's going to look like. What we now rely on is technology and engineering. This is a manufacturing process, which is why the US has quickly become the #1 producer. The whole guessing game of where I should put the 7-inch hole in the ground has disappeared. Now it's who's the most efficient oil company, who's the most successful at what they do, who can execute the best, and how do I buy minerals underneath their wells? So it's a $500 billion industry. This is what it looks like. So this is the current modern Grand Canyon. Each one of those different layers you see in the Grand Canyon wall, it's about 9 atmospheres from the surface of the Grand Canyon to the bottom. This is what it looks like in each one of these shale basins. So on this map, you see light brown and dark brown. These are essentially buried Grand Canyons. These were all discovered in the last 20 years. We knew they were there. We just didn't know how to get the oil and gas out of it. So it's kind of like looking at a puzzle. You're trying your best. You know it's loaded with oil and gas. You just can't figure out what you need to do to let that oil and gas flow to the surface. Engineers come along and go, bingo, we figured it out. What they figured is the rock was tight. The rock did not have openings or pore space. It didn't have the normal components. What we used to drill the last 100 years looked like sand at the beach. You go down to the beach, you grab some sand, you hold it up, the water runs through it. It's very porous. It has a lot of fluidity to it. Well, that's what we used to drill. We were finding old river channels and old buried lakes, et cetera. We drilled all that. We were running out. We didn't have any more. But we knew these huge Grand Canyons existed. We just couldn't figure out how to get that really hard concrete rock to work. So really smart guy by the name of George Mitchell, hardhead. I love hardheads because they're usually contrarians. He told the industry, these basins are loaded with more oil and gas than Saudi Arabia, and I'm going to figure it out. And he did. What he did, he said, look, I'm going to go out and put a well on a 2-acre pad site. It's going to be minimal effect to the landscape and the whole natural, preservation of land. I'm going to drill a well down about 1.5 miles down in the ground, kind of like the bottom of the Grand Canyon. And I'm going to bend that drill pipe at a 90-degree angle. And I'm going to drill out 1 to 2 miles sideways, but it's 2 miles under the ground. Nobody sees it, doesn't affect anything. But that one horizontal well is like 200 to 300 wells that were drilled vertically. Bingo. Now I've got 200 times more access to the oil and gas in place. It sounds really good, except for one thing. It was really hard rock. How do I get that particular long 1 or 2 mile lateral to produce? Here's what it looks like in a schematic. I'm going to drill them down like underground plumbing. Think about this being a 10-story building just flipped upside down. Each floor's got what? Water, sewage, electricity, just like we have here. But if you look on the right-hand side, you see at the bottom where it says fractures. So what George Mitchell decided is when I drill this thing horizontally 2 miles, the way to get the rock to let go of those molecules, I'm going to put in the equivalent of a jackhammer. I'm going to go in and force sand and water. It's going to crack the reservoir because of the pressure of the earth pushing down. I'm going to get those molecules to come out very, very fast. And as a result, it's going to recover my financial investment very quick. And it's going to turn what was a non-economical reservoir into a very economical reservoir. This is about 1997 when George Mitchell made the discovery here in Dallas-Fort Worth under the ground. And that was the beginning of the US becoming the #1 oil and gas producer in the world. We figured out we were sitting on the equivalent of Saudi Arabia. We now figured out how to get it out of the ground. So as this result occurred, this is what it looks like. So the idea, the picture in the middle is a 16-ounce Coke. These are the equivalent of vertical wells we drilled the last 100 years. You drill a well, you hit that little bitty hole at the top of that Coke, you punch some holes in the pipe, and because of the magnet in the earth, the pressure of the dirt pushing down, it can't wait to come out like shaking up a hot Coke on a July afternoon. The problem is when it flowed, it might push out 20, 40, 50% of the oil and gas the first 12 months. The well would be economically dry in 5 years. So We were running like rats on a treadmill, just go, 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 go. That's why we could never keep up. Now what you have is the equivalent of a 3-liter Coke. Got 3 times the size of the orifice, which is the equivalent of that horizontal wellbore. We go in and frack it. We get this huge surge of extraction oil and gas because we have a much bigger hole. We've stimulated the reservoir. The difference is we still have 90% of the reserves in the ground. So these horizontal wells can last 25 to 50 years producing commercial oil and gas, can last 2 or 3 generations in your family. Bingo. The oil and gas industry solved this problem. Low risk, no risk, drilling multiple wells, 100 million acres worth of reserves. Reserves last 25 to 50 years. And we get to sit there and improve every single day using advanced technology and computers and technology to make each new well better and better. How do I know that? Well, let's take a look. So here's an example. The top slide shows a well that was drilled. I can't see the number real quick. I think it's 2012. Yeah, 2012. That well produced what I'll just use numbers. You won't really understand it, but you can kind of see the correlation. That well produced 2.3 billion cubic feet of gas. That's a lot of oil and gas. Call it 230,000 barrels of oil equivalent. If we owned the royalty interest, meaning we were the mineral owners in that well, we made $945,000 in 87 months. Not bad. I'll take $1 million, not having to pay for it. Give me the cash. I'm a happy guy. The new technology in 2019, the green example at the bottom, produced a little bit better, 2.6 billion cubic feet of gas. It did it in 5 months. Why? The drilling was better, more efficient, stayed in zone, learned how to treat it better, better engineering. So this bottom example got in 5 months what it took them 87 months to produce using old technology from 8 or 9 years ago. So now when I think about the success or failure of mineral investing, if I'd invested in 2012, I would have been pretty happy, but I'm a lot happier today knowing I could make $1 million in revenue in 5 months. Now you've got Troy's attention. Now I've got Eng's attention. Now I've got investors' attention because why? I now can see not only success, but I can see accelerated financial returns, which can really surpass most other asset classes based on what's going on today and what has been going on the last 2 or 3 years. So let me explain to you how this works. You can't go buy 100% of the minerals under the wells I just gave you as an example. I can't buy 100% underneath there because some landowners have owned it for 100 years in their family. They won't sell. They don't need to sell. We look for the granddaughter of Mr. Jones, the farmer who lives in Seattle, who doesn't know she owns it. She inherited it. And we find that person in the courthouse. We make them an offer to buy their minerals. They have no clue that one, an oil company is about to drill. They have no clue. It's not going to be a well, but it's going to be 5, 6, 20 wells. And they sure have no clue what the economics are and how much better it is today. So our company specializes in looking for smaller tracts of minerals, putting them together in smaller portfolios that allows us to be very diversified. Each color represents a different oil company, a different area of drilling. So when we put it all together, you, me, Eng's investors, all of us together have not only bought producing cash flowing wells, but we've done it in a way that gives us maximum diversity and a lot of growth potential by additional wells and value from reserves being produced. As an example, if you were to invest in that same model, but you did it over 3 or 4 projects, now what you find out is you're in 20, 30, 40, 50 tracts. Each one of those tracts has different wells, different operators, different oil companies. It is what I would call the maximum diversification and growth opportunity in any asset class in the energy space. Now, the reason this has come together is that I've been doing this since I was 20 years old. And what I recognized is for 30 years, I was always on the drilling side because I liked tax write-ups. I wanted to drill. I wanted to keep 75, 80% of the well. I liked the whole component of what was going on in the drilling side. And I really couldn't buy the minerals because they were all vertical wells. The only people buying the minerals were the geologists, the oil company, the CEOs of the oil company, because they knew months ahead where they were going to drill. I had no idea where they were going to drill. Today, it's different. Today, we have the internet. I can find out what Exxon drilled last month. I can find out how they drilled it, where they drilled it, all the details. You couldn't find out. 20 years ago, you had guys sitting at the gates with a pair of binoculars counting pipe in the rack to see how much pipe they had and calculating how deep the well was. That was technology for the oil industry 20 years ago. Now I've got engineers go online and we can find out wells drilled last night, what they produced, every detail of every well in Oklahoma where we focus. We know every detail all the way back 100 years ago because they've uploaded everything online. We have so many tools today. We didn't even have 5, 10 years ago. It has changed the investment strategy, the risk strategy and profile in minerals because now we're playing with what I would call mainstream information that has brought a very, very lucrative asset class to the market. So here's what it looks like. When I do an internal review of any given portfolio, on the left side, you'll see the things we look for. How many acres are we getting? What price am I paying? What's my royalty percentage? If it's a really tight lease and maybe the person who originally owned the minerals was not that smart, they got 12.5%. Well, guess what? I'm going to pay you a whole lot less for a 12.5% share of the royalty, unless I have a really smart guy who says, hey, I got 25%. It's worth twice the price, twice the revenue, twice the reserves. I wonder how many wells they're going to drill, how many have been drilled, how many can be drilled, how many formations exist. All these things go into our calculation as a company, and that's what we look at valuing. So take a look at a real estate as an example. You're going to go look at an apartment complex, whoever you're with or you're investing on your own. You're going to look at occupancy, comps of other apartments in the area, rents. You're going to be looking at net operating expenses and costs. You're going to be looking at what if I retrofit it? What if I rehab it? You're going to look at all those components and decide what the value is. It's the same way we do in oil and gas. It just has different variables within that assessment or analysis. Here's the key thing to remember. Minerals are 100% net cash flow. Once you buy a mineral acre, you have no more bills. You have no more expenses. You're never going to get a capital call. You're never going to be part of the liability of plugging the well or environmental if the well blows out. You have no risk, no liability, zero. I've been in minerals for 35 years. All I get is a check every month from every well I own interest in. My secretary lays it in my inbox. I get carpal tunnel from writing the endorsement on the back of the check or calculating my checks in the bank. It's 100% passive. The oil company doesn't tell me what they're doing. I can't tell them what to do. All I know is every single month, they get the money in from the oil and gas buyers. They pay the oil company operating my minerals, and I get a check 30 to 45 days later. I don't know any more path. The only struggle I have is just trying to figure out all the guilt I'm having from $100 oils these days. Other than that, I'm pretty good. Let's just recap it. Immediate cash flow. The only minerals that we buy are proven producing cash flow. We don't buy speculative minerals. Zero holding costs, capital costs, liability, no environmental. Major lease operating the assets for free. We have major billion-dollar oil companies. We're not talking about Johnny's Oil Company. We're talking Chevron, Marathon, Exxon, Ovintiv. Every one of the operators we have are multi-billion-dollar oil companies, the smartest oil and gas people in the world. In fact, other countries hire our people to go run their oil fields because we have the most advanced technology. The thing I want you to keep in mind in today's chaotic world, we're all looking for ways to simplify our life. We like investments that we like. We're in crypto, real estate, we're doing different things. It's nice to have an asset class you can put into your basket where it's only just checks coming in. Oil prices go down to 50, I still get a check. Oil goes to $129 last week, I still get a check. So my checks will vary. My checks will go up and down. I'm going to use an example. 10 years ago, I bought some interest up in North Dakota in what they call the Bakken Trend. A couple of wells were drilled. I made great revenue the first 5 years. It's been almost a decade, 11 years. They drilled 9 more wells on minerals that I had. My check was running about $1,000, $2,000 a month. I got a check in December for $235,000 10 years after because they drilled 9 brand new wells. And those 9 brand new wells look like this Coke right there. They came in like gangbusters. I got paid $80, $90 a barrel. And because of the value of the minerals and the value of those wells producing, I got $235,000 revenue in a single month. Not bad. Now, those wells will last 25 to 50 years. I'm not going to get $235,000. I might get $20,000 or $30,000 a month. I'm still not going to cry. All right. When you look at what we do, and this is part of what I explained to Eng we would do, one of the key things for you as maybe a novice investor in energy is it's a very tough business, no different than crypto or self-storage or multifamily. What looks easy is not. So hopefully what Eng and I are doing with Eckard and his organization is we're coming together with capital and brains and sophistication to learn about minerals, but also to give some groundwork as to why maybe Eckard can provide that kind of information with regard to education and of course, knowledge. We've been doing oil and gas mineral buying in Oklahoma for just a little bit over 4 years. I think we're 67 portfolios deep. Cash on cash return today is 17.812%. That's going to escalate substantially because most of that cash on cash was oil and gas prices in 2020 and 2021, which was $40, $50 a barrel. So we sold that huge flush shaken 3-liter Coke. We sold it at discount prices, but we also bought it cheap. See, we didn't mind buying minerals because the state of Oklahoma had a big sign saying going out of business sale. Every sophisticated investor knows you make your money on the buy side. When oil prices crashed, COVID set in, Eckard didn't run to the house and put on a mask. Eckard went out and said, Oklahoma's 90% off sale. Let's find some smart, contrarian investors who understand energy is the core of the US economy. And let's go buy mineral rights from people who have no other way to make money except sell off what they own. So that's what we did. Now I'm going to throw the last thing in because Eng asked me to touch on it just a little bit, and I think it's important. So some of you are long-term players. You like that cash flow. You like what I just described in minerals. But some of you, like me, you make a lot of money. And all we know is one thing: the federal tax we pay is a zero-sum game. Whatever we pay in taxes does not ever come back to you. So if I make $1 million and I fork over $370,000 in taxes, I now am playing with 63 cents on the dollar of what I made to try to create wealth. If you can figure out a way to put that money to work instead of paying taxes, you have a chance of substantially increasing your net worth, retaining those dollars, and increasing the breadth of your portfolio. So that's called working interest or domestic exploration. In 1986, a year after I got in the business, they passed the Tax Reform Act because we were running out of oil, and they wanted to reward high income investors by saying, if you'll drill domestic wells, we'll give you big tax write-offs. Back then, it was like 70% tax write-off the first year, and you deducted the other 30% over 5 years. Well, President Trump, when he took office, decided he wanted domestic exploration to really ramp up because of national security in oil. So he passed the 2017 tax law and said, look, if you buy equipment, you buy trucks, you buy this, and if you drill domestic oil and gas wells, 100% of what you invest is written off the year you write the investment. So what you get is you get the opportunity to drill 98+% success wells horizontally in places like Oklahoma. You got wells being drilled today that can pay out financially in less than 18 months. You get 100% write-off. I put $1 million in any one of these wells you see on the screen, I get $1 million tax. I call my CPA and go, I don't owe taxes this quarter. Why? My $1 million was just put into oil. I just made myself $370,000 of usable capital to create wealth. Here's the other thing. This is what most people don't get in, and I think it's important your audience gets. I've got major oil companies drilling with no tax deduction. So if Exxon spends $10 million, they need $10 million to be returned. I invest in that same $10 million well, I only need 63 cents on the dollar. So unless I assume Exxon, Marathon, Chevron, and these majors are 37% dumber than me, 37% more wasteful than me, there's a reason why I only participate with major companies. They're dollar for dollar, cash on cash economic models. I'm playing with 63 cent dollars. So I just gave you a little list of how things go. The wells are found, they're permitted, they're drilled. Everything I like to tell you is simple. It's like riding a bull elephant. Exxon's going to drill the best well with the best technology, with the best experts. I'm simply owning 0.5%, 1 or 2%, and I know I'm going to get the best price for my oil. Oil's going to go to market. I'm going to get paid. So there's a huge advantage in doing exploration when you have major oil companies involved. I just thought this would be fun for your audience too. This is an actual pad site. In this particular pad site, it's like a miniature city. There was 13 wells drilled, 7 drilled underground one way, 6 wells drilled the other way. Wouldn't you love to be the mineral owner on this? Because this was some serious cash. We actually own minerals in this unit, believe it or not. And what they did was they spent about $120 million. Now you think, if I spend $120 million on real estate, I better expect a big stall condo or big project or 10 or 15 self-storage. This is $120 million invested by EOG right here in this section. So if we had written the check, it'd be $120 million in write-offs. 15% of the income would be tax-free. All 13 hit, and based on the production from these wells, looks like all these wells paid out in less than 24 months. That's why horizontal drilling in the U.S. shale plays are so attractive, and high net worth investors and high income investors are wanting to be in minerals and working interest because it's a great tool to do 1031 exchanges, reduce your tax liability, make 25 to 50 year tax income. Here's an example. 100,000 invested in exploration under Trump's tax law. This is the last year for 100%. Next year, I think it goes to 90%. But immediately I've got 37,000 for every 100,000 saved. So it's really a fantastic tool. But let me tell you, you got to invest in the right kind of well with the right company. It's not any different than looking at race cars. You go to NASCAR or Indianapolis 500. Everybody can be in the race. Everybody beats their chest. What you really want to find is the driver who's done it, who's cool as a cucumber, who's successful, been around the track enough times, they're not going to crash, they're not going to wreck, and they're not going to wipe out your investment dollars. It's just finding the smart people. This presentation, I'm going to forward to Eng when we're done. He'll have this to send to you that ask him for it. But what I've done is I've given you a comparison between mineral ownership and working interest. That's kind of the A choice or B choice. To be candid, this is what most of my investors do. They'll invest probably $67 in minerals and $37 in working. In other words, a 2/3, 1/3 split. And what they're now doing is they're getting so much money coming off their minerals. They're using the income off the minerals. They're trying to use working interest to offset that. And they're doubling on the revenue, reducing their taxes. And now it's become a great kind of a 2-cycle engine where they're just doing it back and forth. I'm going to wrap up with the last couple of slides. We're on our biggest portfolio to date. Eng and I met for dinner 3 or 4 weeks ago. We talked about this project. This is a direct result of our company focusing on one asset class, one geographical area. And what's happened is we had a consortium or a seller come to us with a project that the acres of minerals in this foundation project equals more than what we have in all 64 portfolios the last 3 years. The way that came about is when you do what you say you're going to do, you pay cash, you close on time, and you work very hard like Eng, building your reputation. People come to you because they know they can do it confidentiality. They know they can give it to you and you'll execute. So what we ended up with is we ended up having about 12,000 acres across the main core of the Oklahoma Anadarko Basin. This portfolio starts out with 351 wells. It's about 20 to 25% lower cost than anything we could buy on its own. We agreed to buy the entire $100 million portfolio because we believe our partners is our bankers. Each one of our clients are our bankers. We went out and talked to some of our bigger partners and said, we think this is a fantastic purchase. Can we count on you to be our partners and close this? So far, we've been out about 3 weeks. We're at about 75 million committed out of the 100 million. And this is a testament to the results, the technology, the acquisition team I have, and the results. This is just a fun little chart. Everything in red. It's called a heat map. And what it does, it pulls electronically all the activity in Oklahoma. The brighter the red, the brighter the bullseye. It's where all the oil companies have decided this is where we want to be. Everything you see in those little green squares are minerals we already own. Everything in yellow is what we're buying. We're absolutely in the core gut heart of the hottest areas in the Anadarko Basin. And this is what it looks like. So the black lines you see are existing horizontal wells. The green is what we own. The yellow is what we're buying. These are like buying a pen of pregnant rabbits. You're going to get one well. You'll end up with 4, 8, 12, 24 wells. That's like owning a 4-plex, an 8-plex, or a 24-unit apartment complex, and you did not pay for the extra 4, 8, or 24 apartments. You get free revenue from them because you don't spend a dime. Hey, look, I don't know about you. I love the beach. Every time I put my feet in the sand, I think about what's going on that I got to call or I got to get. I was down in Cayman one time, Eng, and I had somebody call and say, hey, your lake house had some winds, blew the roof off your lake house. I go, really? I mean, on the beach, enjoying myself. My lake house has the roof blown off. I'm getting older. I'm 58. It's not too old, but I'm at the point where can I invest, beat inflation, where I can beat the average rate of return and I have no exposure to risk or liability capital costs. There's only one direction, that's mineral rights. So it's all about cash flow, asset growth. I've been doing this since 1985. I'm honored that you allowed me onto your show, and I'll let you start hammering me with questions if you have any.
Thanks, Troy. And I'm very excited to present this opportunity to you guys next week.
Yep.
It's one of those things where we all kind of need a little bit more passivity in our lives in this chaotic world. I know I do. I do a lot, and would love to have a couple of investments that I've already have, and working with Troy on this that cash flows and it's very passive, and it's generally no liability. I love that 15% discount on depletion benefit. What is that?
Well, what they decided, Eng, is that because you're draining your reservoir, instead of like depreciating equipment or depreciating a piece of real estate, they said, look, we're going to give you one of two ways: cost depletion or percentage depletion. Well, cost depletion is hard because you got to calculate what you spent. Whether you own minerals or whether you own working interest, the IRS says 15% of your income you don't pay taxes on. So that's another big compounding factor that I'm only paying taxes on 85%. I have found most of my really deep-pocketed wealthy partners have used oil and gas as a great kind of anchor in their portfolio to manage the taxes, offsetting their other income. They use it for 1031 exchanges in and out of traditional real estate. And they really look to modify their total income bracket by the working interest, the depletion allowance, and it's really become a great tool for them. So for those who really take the time and listen, this is a fantastic asset class if you do the right thing by investing with the right company with the right strategy. I find most failures in oil and gas is not necessarily because people are not trying or listening. To be candid, up until about 2015, we were drilling a lot of wells. And the fact of the matter is, we were drilling 60% dry holes. It was brutal. Now, because of horizontal drilling, it's like 98% successful wells. So I get a big tax write-off with a 98% success rate, which is why Biden last year was trying to get rid of the tax write-off. He said, we gave you guys the tax write-off because you had so many dry holes. Now you're hitting everything you drill, and we're still giving you the tax write-off. And go, we don't see the problem. But of course, the other side who's trying to change the tax law did. But that's the real nice advantage today is big tax write-off, 98+% success rate. It's a great combination.
So you mentioned dry wells. One of our guests asked, isn't it extremely hard to find oil and gas on the ground? I always heard that most wells are drilled or dry. I would imagine some investors in the past have invested and they probably not gotten what they wanted from the well. And can you speak to that?
Yeah, I used to have a client. He said my middle name was Troy Dryhole Eckard. I said, that's not really a nice name to call me. One of the things and I laugh because I have so many good friends that are older than me that are really, really good geologists, geophysicists. And I said, look, there's only two people that are wrong every day of the week and they keep their jobs. That's geologists and weathermen. I said, because as much as they have and PhDs and all this studying, when you drill a hole in the ground vertically, and you try to find a buried river channel or a small mountain range, you miss it by 100 feet, you're dry. It's uneconomical. And I can tell you, I've lost $1 million in a single well of my own money that we thought was going to hit, and it was dry as a bone. So the person asking the question is very, very right. Up until horizontal drilling, the U.S. went from back in the 70s, it was about a 67 to 70% success rate. Mm-hmm. By 2005 and 6, right before the big spike in prices, we were running about 67% dry. We literally were drilling like rats on a treadmill because we didn't have the technology. So what's changed when you look at that previous picture on my slides, where you see this Grand Canyon, you and I could go to the current modern day Grand Canyon. You could stand on one side, I stand on the other, go, look, all we have to do is stay within 200 miles wide, 400 miles long, and is stacked 5,000 feet thick of oil and gas. We don't have to, I haven't talked to really a geologist in 10 years. I have a geologist on staff, but he's more trained in geophysics and geology. And the reason I have him, he's more able to help us calculate total reserves in place, not where to drill. So this industry's changed from, like your guest is asking, from rolling the dice and hoping you hit. That's not the case. One more thing I should add. I call it cowbird investing, and most of you don't know what cowbird investing is, but I'm an old redneck from South Texas, and I grew up right along the Mexican border, and I used to road cattle, and I used to go out when I was a kid branding cattle, and we get out to these big pastures, and it'd be 1,000 acres with mesquite, 20 feet tall, and I go, how in the world are we going to find all these cows? And he said, cowbirds. So what does that mean? He said, up in the air, you'll see these white birds. They hang around the cows. We follow the birds, we find the cows. Well, that's what it's like in the U.S. Any one of you right now can Google and go, where are all the U.S. drilling rigs located? You'll have a map. You'll see where every rig's located. Now, watch how easy this is. Out of basically 100 million, it was like 43 million acres in the Anadarko Basin, close to 100 million in Oklahoma total, 43 million acres of oil and gas in that buried Grand Canyon called the Anadarko Basin. There's only 50 rigs active. 50 wells drilling 1,280 acres apiece. That's about 55,000 acres a month. That is the very best minerals in the entire state, according to Exxon, Chevron, Marathon, and the 10 major companies. So what allows us to miss those dry holes is because of today's internet access and information and data. We know not only where they're drilling today, we know where they're moving those 50 rigs tomorrow, next month, 6 months from now. And what we do is we go look to buy minerals under wells that are already producing, and we know where they're going to go in and drill that 4-plex, 8-plex, or 24-unit apartment complex. We're using technology and a very well put together team between engineering and geology, et cetera, to know where those oil companies find the very best minerals. So I'm telling you, I don't think I've drilled a dry hole in about 4 or 5 years. The last dry hole I drilled was a vertical well in Louisiana, and that was the last vertical well I'll ever participate in. I haven't had a dry hole horizontally in forever.
So all these professional companies, very cash rich, I would imagine. They've done well over the past few decades. ExxonMobil why don't they own the mineral rights themselves? Why don't they buy them? Why don't all the oil mineral rights are owned by oil companies now?
So oil company industry is a lot like real estate. You'll have somebody who's a raw land developer. They don't ever go vertical. They want to just develop it, entitle it, annex, and sell it to somebody else. The individual who decides they're going to do a big box commercial development, well, their job is to take the entitled land, sell it off to Home Depot and parcel it out lot by lot. Then you got contractors who make all their money by building verticals and doing the construction. Then you have property management companies. The oil and gas industry is really in three sectors. It's upstream, which is the drilling and exploration, midstream, which is pipelines, refining and transportation. And then downstream is petrochemicals and getting it to the customers like you and I at our home. In that upstream market, Exxon's very clear. We drill for oil and gas and we book reserves. We want 75 to 80% of the reserves. We don't have the money, or it's not in our business profile to buy minerals. I only know of one or two oil exploration companies who actually invest in minerals. Continental Resources is one of them. And it's just the way it is. When you go to the Gulf of Mexico, I started a company 10 years ago that now owns, and I'm on the board of, the second largest natural gas pipeline in the Gulf. Shell or Exxon or whoever's drilling in the Gulf says, we don't put pipelines in, but when we make a major discovery, if you won't put the pipeline in, we'll put it in. But then as soon as we get it filled and we lock in our own fee, which is low, we'll then sell the pipeline to a third party. Oil and gas industry is very much segmented like real estate. You're either a developer, raw land guy, entitlement, or your property management company, et cetera. Oil and gas is the same way. They just don't buy the minerals. They lease them.
That makes a lot of sense. Yeah. We have a few guests ask about, is this hydraulic fracking and their concerns about environmental concerns or even legal has been banned, or is it banned?
No, it's not banned. Where it's banned is in states that have a lot of political pressure because of lack of information. So here's when you say hydraulic indicates fluids, like hydraulic fluid. What's happened is the oil companies have decided a long time ago, fracking is really about taking a rock that's as hard as concrete, and they say, look, if the pressure in the rock to crack it is 2,500 pounds per square inch, if we can inject water and sand, and we can inject it at 3,000 pounds per square inch, it's going to crack. When it cracks, the sand, beach sand, will inject that sand by carrying it with the water, and it goes in and it goes in between the cracks. That's why they call it a proppant. It goes in and props open the fractures, allowing the molecules to expand. Some of your guests may be scuba divers. No different than taking a bottle of air down 3 or 4 atmospheres and it compresses. It's the same thing as releasing it as it comes to the surface. When you fracture and break that rock open using sand and water, the sand will get propped in there. And then those molecules begin to expand because why? The magnet in the earth is cooking like a pot of rice. The rock itself is the rice, okay? And the well bore is like the top or opening up the rice and letting the pressure off. The gas comes out. It has liquids in it like butanes and propanes. The crude oil is like being carried by the gas because it's heavier. So that's going to be like your condensate coming out of that pot of rice. And so what you have is basically a melting pot. The reason why the public was scared about the environmental is that they were trying to say that there's gas coming out with the water. It's physically impossible. Let me tell your audience why. Some of you are very, very smart to be environmentally conscious and aware. You don't want to be contributing to the earth and destruction of the planet, et cetera. I get that. But here's the logical. When you drill a well down initially, you're going to go to about 1,000 feet where what they call freshwater zones. You put a 12.5-inch pipe in place. They then put a plug and they have to pressure test it, okay? When they leave that surface casing, the next size pipe is going to be 7.5 to 9.5 inch, and they'll drill that all the way down, let's say 1.5 miles, 2 miles. The pressure at that depth now is 3 to 4, 5,000 pounds per square inch. If there was any communication between the pipe that's 1,000 feet protecting the fresh water and down below, that 4,000 pounds of pressure would invade the 2,000 pound pressure in the fresh water. Physically, mechanically impossible. I love Matt Damon in most of his movies, but that movie was completely false based on misinformation. Now, I will tell you what the oil companies have done, which I appreciate. They started off using different chemicals to lower the friction so you could get more sand to be carried. They were then consciously aware of, let's stop using some of those friction resistant chemicals. Let's go to more natural. And to be honest with everybody, what they finally figured out, it's not how fancy the chemicals are to get that sand, you needed more sand, because if anybody knows what happens when you heat up sand, it turns into glass. What happens when you stand on glass? It shatters. So what was happening is they were injecting the sand 12 years ago, like the financial example I gave you. The heat was heating up the sand. It turned to glass. The weight of the earth crushed it, and those fractures closed. That's why the declines were so sharp. So somebody decided, you know what? Why don't we just jam more sand in there? Instead of 2 million pounds of sand, let's put 20 million pounds of sand. Now the fractures don't seal. They stay open. Now you have wells that are not declining at 60%, they're declining at 20 or 30. Now they'll last 50 or 60 years. But it's sand and water with very, very environmentally safe, friction resistant going into the wellbore. Let's face it, at this point in time, the oil and gas industry is under tremendous pressure. Most people think it's going out of business. I got news for everybody. You just have to look at the charts. In the next 40 years, there's no doubt alternative energy, wind, solar, other types of energy are going to start taking a larger percentage of total energy consumption. But oil and gas, fossil fuels, coal and oil and gas energy run about 85% today. They're probably going to run 83% in the next 30 years, but it's 83% of about a 10% higher demand market. Oil and gas is going nowhere. It is the cheapest, most accessible energy resource. The best thing we can do is what we're doing now. Carbon sequestration, they're offsetting, buying carbon credits. All these oil companies are scrambling to help offset the carbon that they make. It's a good thing, honestly. I don't drink out of cups and straws. I mean, that's in every way. I try not to do anything that's going to use petroleum product, but the Tesla car you're in, the computer we have, the microphone, everything in Eng's photograph is made from a barrel of oil, transported by oil, carried by oil, byproduct of oil. So it's not whether we are hurting the planet. Essentially, we become the stewards of oil and gas by being the mineral. We get to decide who to lease to. We get to decide what's going on. And so in this case, we're not causing new wells to be drilled. We're buying minerals under existing producing properties. We're simply benefiting from the revenue. The good thing about the shakeup 2 years ago, it always shakes out the lower tier oil companies who may not be quite as good as Exxon or Chevron or Marathon. So these economic shakeouts every 4 or 5 years, it kind of gets rid of the lower tier. We're still drilling with the very best oil companies in the world who have the highest conditions and policies for drilling wells.
So that shakeout that you mentioned, I would imagine that's part of the downside. Some of our guests are asking, talk about the upside. What are the downsides?
Yeah, the downsides are as follows, and I'm kind of a sarcastic guy, just Eng knows that a little bit. The downside is I'm Leo DiCaprio, and this is Catch Me If You Can. I'm really an oil and gas guy. As soon as you write the check, I'm buying my new island out near the Caribbean, and this is all a bunch of nonsense, right? That's your first thing is the source of data reliable, credible, et cetera? You can look me up online. I've been around forever. My fingerprints are on file with the FBI since 1985 as a licensed broker, et cetera. So absent the person, the company being fraudulent, now let's go to the next risk. The next risk is we're incompetent. We're buying minerals in Oklahoma, in the Anadarko Basin, but instead of being underneath wells, we're buying on the edge of the fringe where, truthfully, your minerals are worthless if somebody doesn't drill a well. You can own all the minerals you want until somebody pokes a well. How are you going to get the oil and gas out? I've seen a lot of mineral buyers the last 3 or 4 years who bought minerals from flippers or scam artists. They're in the Anadarko Basin. They'll never see a well drilled anytime soon. Why? They're on the edge. It's the most expensive. There's no infrastructure. So they own minerals, never see $1 in revenue. It's important you have competent management and leadership that knows how to buy cash flowing proven results, which is why we've been doing this so long, why we have 64 portfolios. So the real downside is, in my view, is that we end up with a salt water as energy in a year and everything fossil fuels goes away because somebody says, if you add salt water with this tablet, now it runs forever, right? It's not likely to happen. Here's why. It's the byproduct. It's not just the gas in your car. It's the byproduct. It's 2/3 of a barrel create plastics, medicine, synthetics, syringes, your laptop, your cell phone. It's what we've done as a society using petroleum products to create our lives. I always say the only way you can truly not be a hypocrite about green energy and the planet, you'd have to stand butt naked on the side of the road using sign language on a dirt road to say I protest oil because everything else is going to have oil in it. I don't think the downside necessarily is commodity prices, Eng. I think the reality is the oil companies need about $38 a barrel to break even. We drop below that for no more than about 30 to 45 days. Since we're not exposed to any kind of expenses, we still made profit, made money at $38 a barrel. We didn't make as much as we're making today. It's about economics. Our financial model is extremely tight, very conservative, because I usually buy all the minerals before my investors buy. I'm 100% at risk. And so as a result of that, our team, our model is extremely tight on who we buy with, what the economics look at, what commodity prices are, because minerals should be a zero chance of lost capital. It should be about how much you make, not whether you make money or lose money.
Yeah, and I love that, especially in certain times, like this is, we're not levered, right? We don't have a mortgage. We don't have a bank that if you don't pay, oil goes to 30.
100%
we're not getting any risk. Like it's just time.
Yeah, and I will tell your audience that we've been at this for 3 years, and so honestly, it's just been the most perfect timing. We geared up when the market fell apart, and there's a huge sign that says going out of business sale. So we ramped up, created a really, really big following of investors. Now, I'll tell you, I talked to our engineering team up in Oklahoma yesterday. They said, look, Troy, there's no cash buyers in the market. In fact, there's still private equity groups coming out of New York who've been told by their pensions and their colleges, stop investing in fossil fuels. So the capital is completely disappearing. All the negative news you and I hear about Biden is stopping oil and gas, it's great news for us mineral owners. Why? It's barrier to entry. If I own producing oil and gas wells, right now we have over 700 wells. This foundation portfolio has another 400 being added. Every well we own becomes a more precious, valuable commodity because we're consuming more, we're supplying less, drilling is becoming more difficult, regulations are higher, the barrier to entry is higher, which means what? We're going to get paid a lot more for the oil and gas coming out of the ground. So my clients always go, why are you laughing when they make this new regulation? The harder they make it for us to drill, the more valuable my minerals and my oil becomes. It hurts the economy, it hurts the country, but for those of us who own minerals, we're going to have to spend some money on counseling because we're going to feel really guilty how much money we're making. I got that counseling money set aside.
It's the bottom of the hour. Are you okay to go a few more minutes?
I can last forever. You go for it.
Sounds good. All right, we got a bunch more questions. Keep them coming, guys. I'll try to tell Troy more rapid fire answers.
I'm good to go. I love this.
So I think we mentioned this in the presentation, but just to reiterate, how do you know minerals exist when you make an offer? I looking at the map, it's for me, I think of it as, hey, I know this house sold for X, this house over that. So if I build the house here in this empty lot of land, it could sell for this and that. It's comps, right?
Well, it's comps, but what we do is we kind of do it a little backwards. We know probably different than you do in real estate. We look at an area of interest and we decide in this area, rent houses are going for an average of 250,000. I'm looking for the arbitrage. I'm looking for the guy who has a bad lot. Maybe he owns a double lot. He doesn't know that he can sell his lot for 100. So you buy his house, you keep the house and you sell the lot for 100,000. You make an extra 100,000 because he wasn't aware of it. In our case, we're mainly focused on reserves and cash flow. So we look at an area and say, okay, here's 10 sections of land. It has a single well drilled on each one of those sections, but they're drilled 12 years ago, 10 years ago, right? Antiquated, old style completion. We look at the engineering software we use and we model it out and say that well produced 200,000 barrels of oil over 6 years. We then look at wells drilled 2 years ago and say the new wells are making 200,000 barrels of oil in 5 months. That mineral owner has no clue because they got a check. They live on 20 acres with a mobile home in Oklahoma. They got a check. They're happy, man. They're making $3,000 or $4,000 a month. Now their check's $300 a month. You knock on their door and say, we know by court record, you own the minerals in this section. We know you've been getting a check for 5 years. We would like to buy your 20 acres of minerals. Nope. My grandfather said never to sell minerals at all. Okay, we get that. Why don't we buy 10 of your 20? You de-risk the chance oil is going to go down because, it was negative 37. You also might realize that maybe the check today is like 10 years of income for you versus waiting at $300 a month for the next 10 years. Maybe you can pay off that house. You can buy your daughter's college fund. You can, et cetera. Okay, I'll sell you 10 of my 20 acres. We look at several things. What the cash flow is from the existing well that's producing. We look at what we know to be factual, which is the oil company's already permitted for 4 new wells 2 miles away. He doesn't know it because he's at the end of the 2 miles. We know that the wells next to him that were already drilled 4 months ago by his neighbor came in at 1,000 barrels a day and paid out in 6 months. He has no clue because he doesn't do it for a living. So like a professional real estate expert, You're looking at annexations and entitlement. You're looking at cash flow. You're going to those self-storage units. You're seeing how many locks are off the door. You know what the occupancy is. All kinds of tricks of the trade. We're doing the same thing. So our offer is based on, we want to be where he's located. We know what the minerals are worth in terms of cash flow and reserves. We know what we should pay, could pay, will pay. And since we're a cash buyer, we already know ahead of time when we contact that person, here's our offer. We can close in 7 days. Well, how do you know? We've already run title. We already know you own it. As soon as you say yes, we will set up a closing 7 days later. We'll bank wire. What's the nicest thing? And I'm going to give an example to your audience. Most of these families are second, third, fourth generation people in Oklahoma. Their grandfather settled the land 150 years ago, right? We had a guy call us about 2 years ago. We notified him by phone. Hey, we saw in the court you own 300 acres. Yep, never going to sell my minerals. Can't afford to sell them. My grandfather said never to sell them. We understand. Here's our name and number. If something changes, call us. 6 months later, 7 months later, we get a call. And the guy said, hey, you guys called me about buying minerals. My mom's 82. I got to put her in a nursing home. My grandfather's going to kill me, but I got no choice. I need to sell 40 of my 300 acres because I need the money to put her in a nursing home. My son's a geologist. He's mad at me. But the key is I'll sell 40, keep 260. Now I'm taking care of my mother. I want to buy my neighbor's farm. I want to buy a John Deere tractor. So these landowners have figured out they can monetize minerals as an asset by selling it and still maintaining their farm, their ranch, their property. It's become more of a marketable asset, and that's what they do with it. And then you had the speculators out of Wall Street that came in 2014. Ing. They threw $30 billion in 9 states buying minerals based on put 100 million, guess where they're going, average the cost, hope it works. Those knuckleheads pay 15, 20, 30,000 an acre. They spent $100 million like drunk sailors. They found out that 2/3 of their stuff was never drilled. Now they're trying to sell some of those minerals. All they really did was they escalated the market twice, 3 times what it was worth. We weren't buying. We waited. They lost their money. They left the market. They're not coming back. We last year in 2021 were the #1 oil and gas mineral buyer in the state of Oklahoma, the #1 deed filer. We're a small family office in Dallas. We did $82 million in minerals last year. We were the #1 buyer. Why? We're the only ones that had cash. That's the way it works.
Speaking of cash, when is this great investment going to expect the first distributions?
Every mineral portfolio that we do is 6 months, 180 days from the time we close it out. And I won't talk as much as I normally do. I'll make it short. We have to file the deeds in the courthouse. We get the stamped ownership deed back from the county. We send that deed to the oil company. They have to acknowledge that we legally bought it and own it. It has an effective date. If I buy a mineral today, my effective date is March the 1st. Oil company gets that deeded, filed, stamped copy. They go, okay, our land department verifies that Eckard owns it. It's effective March the 1st. They pass it to accounting. Accounting puts it in their system. 60 days later, we get a check. We'll get a check generally about 180 days, 6 months after we file the deed. Our company distributes checks twice a month, the 10th and the 25th. Every new track, every new mineral, every new well, we send out on the 10th of the month when we finally get a check from the oil company. Then the 25th is what we call our major revenue distribution. We send out 700 plus checks a month, and it goes out to investors like yourselves. And we do this every single month. There's no expenses, so it's pretty easy. We take a gross check, divide it by owners. Here's your check. We ACH it, we bank wire, whatever you need done. We don't charge any fees for that, but here's the most important and fun part. You get all the details. It'll show you every load of oil sold, every natural gas liquid sold. It'll show you all the gas sold. Every company, Exxon gets a better price than so-and-so because they have better negotiations. So you'll literally, your statement could be almost the size of a yellow pages. Our company designed the most advanced mineral app called Eckard Insights. And what happens is now you can get online, look at your account, you'll see the deeds, you'll see the records, you'll see the production for your wells. And now we load all your financial statements on there. So it's becoming more of a mainstream investment. I designed with my team the app, and we did it specifically for investors like yourself who are tech savvy to go, look, I want to check my stocks, my bonds, my crypto. Hey, I also want to see what my minerals are doing. We believe transparency is the best tool for you building confidence that minerals belongs in your portfolio. So that's what we've done.
The investor also asks, is there any recourse to investors if there's a delay?
Any recourse for what?
To investors?
No,
I guess. Okay.
No, none, zero. I'm going to give you the best example, Eng, because I think it's important. So the federal government leased out some of the land in the federal waters when the Macondo spilled in the Gulf of Mexico in 2009. BP was sued for $20 billion, lawsuits everywhere. The only person never included in any of those lawsuits was the federal government as the mineral owner. As a mineral owner, you take on zero liability. You, in that lease, have abstained from any financial recourse, environmental or any liability. And the Macondo spill is the best example I can give. $20 billion, worst Gulf of Mexico spill, federal government didn't pay a dime as the mineral owner.
That's great. So we talked about drilling in the past. One of the guests asked, how do you vet good operators? So remove yourself from the equation. If you were looking to, put money into somebody, you don't want to work in Eckard anymore, but you still like investing in oil and gas.
So I'll give you the easiest answer. In North Dakota, when we drilled wells back in 2010, we could choose from Oasis, Whiting, Exxon, XTO, and we would literally look at an XTO well next to a Continental well, same zone, same cost, or should have been. XTO was 50% more expensive than Continental. They produced their well 1/3 as much oil, took forever to pay out, had to beat them on the head to get the check out of them. In my view, we don't do any drilling anymore with Exxon, XTO, because they're horrible. They're a big behemoth. You'll get your money eventually, but I don't want to be 100 years old when I get paid. Then you have what I call major billion-dollar companies, but they operate kind of like a true entrepreneur. So you take Harold Hamm with Continental. He's the largest player in Oklahoma, owns the most acreage. He's worth, I don't know, $20 billion. He runs that company as if it's a three-man show. Drill the well, drill it cheap, drill it on time, get it online, make cash. If I can find any interest at all in a Continental well, I'm in, because that guy makes me look calm. That guy wants to find oil, make money, make a profit. There's really good operations with people like Oventive. Then you get a little bit step down, call it a private equity group. They've created a little team. They've got $1 billion from a private equity fund. They're going to go out and drill, but they're also not publicly traded, so they don't have any upside to their stock or value. They got a budget. So they might go drill the well, but they might not put 20 million pounds of sand. They might put 10 million pounds of sand so they can stretch that budget and drill the next well. Well, I don't need a three-legged horse. I need a four-legged horse that's going to give me full speed. So we measure budgets and capital and drilling and efficiency, which is why I have my own engineering team, my own geologist, because we go, look, we drilled 5 wells with a company called Paloma last year. It's a private equity group. All 5 wells under budget, all 5 wells hit, all 5 wells online. Our first distribution, first check was a 26% return in the very first check. Why? They need to be successful. They need their money back because they have a tight budget, and they did a great job. So we kind of look at the history, the pattern, and we take all that into consideration because, at the end of the day, we're just like the smallest investors. So we need to make sure that our money's the most protected.
Mm-hmm. One investor is commenting on their personal experience investing as a first-time investor, 50K in oil and gas last January. Yeah. The firm produced 6K barrels per month. You probably have better context of what that is, and distributions of 250. It's probably not what they're expecting.
No. So what he's saying is 50,000 invested. The well makes 6,000 barrels a month. He's making $250 a month. He'll never break. He'll never
so
break
far
even.
at 250.
Yeah, well, he's never going to get paid out. And you know how blunt I am. We had dinner that night. By the way, everybody, Eng told me to behave myself, so I'm going to behave myself. Let me tell you what happens. Big companies right now are keeping all the interest they can get because they want as many wells as they can get, because the wells they're drilling are just like inside the city development. If you have a nice neighborhood and there's several lots left, you're a luxury home builder, you're going to buy those lots because I got electricity, pavement, roads, etc. Big major companies are doing infill drilling in all these very, very low risk locations. But in the oil and gas business, if you want to be in the promoting business and find client business, you're never getting in those wells, ever. So what happens is they go find vertical wells or wells in different areas. They try to make a good story. I mean, some of them are trying to be very good about what they do. They're trying to be honest. They're trying to do it. But what they'll do is they'll buy 3 or 4% of a well that costs $300,000. And they go, well, I got to make a living. I'm going to charge double the price. So they charge $600,000 for 300, or they charge $900,000 for 300,000. Even if the well's good, it's so overcharged, you're never going to make your money back. The other problem is, keep in mind, that it's all relative cost versus return. So if I've got a well and I drill it and it's successful, but it can only do 30 barrels a day, I only got 30 barrels a day trying to pay me back $50,000, and maybe I only own 0.5%. It's pure economics. So in my case, the way I look at it, the way my company is, I look at the actual budget from a major company. The way my company does business is we charge cost plus 15%. And almost every drilling venture, I take the bulk of the interest. If we buy 4% in a well, in most cases, I take 2%. The other 2%, I put 5 or 10 clients in it. Why? I need tax write-offs. I want to drill, and I want to put my own money at risk before you do. We charge the cost plus 15% because we're going to manage that well for you essentially for free for the next 10 to 20 years. I've got wells that have been online 20 years. I'm still operating for virtually for free. So I only charge that because there's a lot of work in the first year of a well. 300 to 500 invoices. You're getting bills every month from the oil company. It's a pain in the neck, really. I only offer drilling to my mineral clients because why? I don't sell drilling deals because at the end of the day, it's a thankless business. The person who asked you Eng, about putting his 50,000 in, he's not going to recommend that company. He's going to be bleeding to death at $250 a month. He's not going to be happy. There's nothing good coming from that relationship at this point forward. He's going to have a bad taste in his mouth. Well, as honest as I am and as hard as I work, when you've got a geologist missing 70% of the time, I don't care how much you and I like each other, you're not getting on the elevator with me if every time I get on there, it drops. So you have to have a real logical plan how you can successfully drill wells. The only way I know how to do it is drill with major oil companies who are drilling virtually 100 out of 100 good wells. I said this a decade ago, Eng, the middle class of oil and gas has disappeared when horizontal started. You went from $2 million wells, now the average well is $10 million. I mean, your 100,000 doesn't even buy the cattle guard. So it's not really a small person's game anymore. The only way you can play it as a small investor is aggregate your money with somebody like me who's talking to the majors every day. And we're literally just picking up their crumbs. We'll pick up 300,000 this well, 400,000 that well, $1 million here, because man, they are like anteaters. They're picking up everything because they want to accumulate those reserves. And with less wells drilling, there's not that much interest left. So I would just tell your audience, the big pitch for all of you right now is that Trump has a tax write-off of 100%. So everybody that calls you or contacts you is going to pitch this 100% tax write-off. Let me give you a secret. Everybody watch. You get 100% write-off on a dry hole. You get 100% write-off on a good well. Let's focus on making money. Let's find a way to drill good wells. You get the same tax write-off. You can lose 100% of your money by setting it on fire in the parking lot. Forget that. Let's go drill wells with majors that give us 100% chance of making money. We'll still get the write-off.
So speaking of the tax benefits, do you see it being reduced, removed in current and future generations?
Oh man, this is such a political comment. Okay, so I'm not going to go there because you told me not to. Here's the deal. You literally have put in every regulation in the world to stunt and stop fossil fuel, and you're begging Maduro and Venezuela for more oil. The guy ran 10 million people out of his country. Here's the problem. In this particular case, we have an industry that is very much capable of producing 18 to 20 million barrels a day. Had we been left alone 3 years ago and not had Russia and Saudi Arabia flood the market, we'd probably be at 15 to 16 million barrels a day. So the fact of the matter is that we have the oil in place. It's incredibly low risk. We have the tax provisions in place. One of the reasons, in my view, they tried to get rid of the tax write-off last year when Biden was trying to push his big tax policy through is alternative energy, wind and solar, do not make economic sense until oil is $125 a barrel. I said this 2 years ago. You can read my videos, my email. I said oil is going to 125 or higher in new record prices long before Russia. Why? The only way you can make alternative work is you got to get the consumer to hate oil and gas. And you got to hate oil and gas because you're used to $55 oil and $1.69 gasoline. Now that you're at $4.99 for diesel and $7 for gas in California, you're starting to go, I really love that electric car and I'm going to take my bicycle, I'm going to take the bus. Those oil guys are greedy pigs. Bottom line is we don't set the price, the traders do, because they have to fill that refinery. We don't set the price. The other side of the coin is, Eng, is this. The truth of the matter is that in this country, our economy is based on energy. Everything. That Uber's going to charge you a fuel surcharge. Amazon's not delivering that box for free anymore. Everything from plastics, those iPhones are going to cost more, the whole 9 yards. It really is an economic benefit for oil prices to go lower. The problem is if you put policies in place that prevent you from growing your business, You cannot extend your supply. So last week and the week before last, Biden was talking to different producers around the world about giving us more oil. 3 weeks ago, he passed his own legislation that prohibited oil companies from putting oil in brand new pipelines, and they would not approve it at the federal level unless those companies could prove they were carbon neutral. Well, guess what? Exxon, Chevron, they're not carbon neutral. You're going to have no more pipelines. I'm just explaining to your audience, this is not a political statement. This is an economic statement, okay? Everything on the supply side is derailed. Capital has left. It's not coming back for 3 or 5 years. We have 100% consumption in America of petroleum product, 100%. Even the most fervent person that's in charge of protecting the environment uses oil every day. If I got 100% consumption, growing demand, and everything buried entry is against it, it's a guaranteed 100% certainty commodity prices are going up. So we're in a situation between trying to make a transition to alternative energy and today's facts, which is rising demand, lower supply, and absence of capital. We're in a super cycle. I know you hear this word, and a lot of people say it, they don't know what it means. We truly are in a super cycle for oil, because if we started today to re-ramp up to meet the supply, take us 2 to 4 years. You're looking at super high oil prices for probably the next 3 to 5 years. Nothing anybody else can do about it. Nothing.
Yeah, I think it's a great time to invest in oil and gas. And by the way, I know some of you guys have questions on investments. We'll try to answer some of them, but we'll be presenting this investment in detail next week. Today's supposed to be just a little education. Of course, people jumping the gun, but that's fine. Happy to.
I think it's important for your crowd to know this. Eng and I are becoming very good friends with the idea of working together on helping all of our investors on both sides understand what he does and what we do. This relationship is about allowing Eng to do what he does best, which is ferret out due diligence and really understand markets, bring it to his audience, allowing him to put his own opinions and decisions on that. We simply are here to support education and information. So what I think is important is as Eng begins to get you involved and get explaining and answering your questions, we're here to support whatever he does. So whatever questions you have, Eng can ask those questions. We'll help answer them. We're very, very transparent, but we're simply humble and very grateful that Eng has allowed us to be able to meet with each one of you tonight on Zoom. But I think the thing, what Eng said is very important, which is this is mostly about just getting your head around the asset class and the advantages. Each individual portfolio is just a component of that due diligence. And I believe Eng is going to do a great job getting that message out to everybody that's on here tonight, plus all of his followers and his investors and partners.
Yeah, I think this year is going to be a great year to invest in commodities and energy, and oil and gases.
Especially since you're in crypto, because I know what you're going to pay for electricity.
I know, it's challenging.
I have so many people calling me right now saying, how can I get cheap gas? Can I put a little, what do you call it, a mining operation right out next to a well? I said, so I'm working with one of our clients in Atlanta right now, trying to figure out how we might be able to find that gas or that cheap electricity. It's going to be pretty interesting next couple of years for sure.
We got a site in Texas coming up.
Oh, good.
I'll talk to you about it next day.
Good.
Let's see if we can answer a few more questions.
I'm good.
So one of our guests asked, do you think there'll be better technology coming up in the next couple of years to improve the economics of oil and drilling?
I think so. I think the way they're improving these wells, we used to drill one horizontal well at a time. Now they turned it into a manufacturing process. My brother passed away a couple of years ago, but before he passed away, he was drilling horizontal wells for major oil company. He died of cancer, but he invited me up to North Dakota back about 2015 or 16. And he said, look, you can't take any photographs. This is the newest, latest drilling rig technology. And this was unbelievable. I mean, you normally have 3 or 4 guys on the rig floor changing out the iron and the bit. They had a guy in a room, looked like a video game. He's actually using artificial intelligence to break the pipe. These were like Star Wars rigs. They pick up their feet and they walk 50 feet. Well, it used to take 3 days. Now it takes 5 hours to move a rig to the next location. They're now drilling. It used to be they would be within 100 feet of accuracy. They drill a horizontal well, maybe 25% would be in zone and the other 75% would be out of zone. Now they're like 98% in zone. So the technology is they're using those triangulation and those satellites and the technology. They've now got computer chips behind the drill bit, sending information instantaneously back to the rig floor. I went to dinner with him one night, and we had guys in Houston and Denver and all over, all looking at the poor guy in the rig, watching his speed and his rotation, his pressure. The poor dude had 9 surgeons overlooking his shoulder. So what used to be a really antiquated kind of, cowboy kind of a business is now 100% technology. Even better with your production. Let's talk about how we know we're getting paid. So on the well site, every single well is now run with a solar panel digital meter, 24 hours to satellite. This guy's in Houston, Denver, seeing 24 hours a day, every molecule, pressure, water, temperature of a well. Well goes down. You don't wait a day to find out your well went down. They literally have guys with trucks saying, well number 72 has got 20 pounds less pressure, go adjust the valve. These guys now are moving instantaneously to produce wells. So you're getting efficiency in cost, efficiency in drilling, efficiency in production. You can't cheat us out of oil and gas. It's metered at the wellhead. It's metered into the valve. That valve then gets reported by digital to the taxing authority, gets reported to the refinery. So we got 4 ways of looking, 100 barrels left and 100 barrels got paid and 100 barrels came out on our check. It's crazy compared to even 5 years ago, but to me, it has just made it that much better investment because it's so disclosed. And I think the technology, not necessarily we may be able to drill a different type of horizontal, but I think what they figured out is how do we drill it, perforate it, complete it to maximize the drainage. And man, I got to be candid with everybody that's listening. The wells we're seeing drilled today, they're not 1 times better, 2 times better. There was a well drill that we own minerals in 2 months ago that Continental Resource drilled. A normal well might be a good well if it produces 30,000 barrels a month. That's 1,000 barrels a day. This well produced 98,000 barrels in 30 days. It produced 200,000 barrels in 2 months. It was a record-setting well. We own minerals under, right? They're now going back seeing what they did right. It's not just the zone, it's how they drilled it and they perforated. So exponentially, they're just getting better. Kind of like Kobe Bryant said, the reason I'm so good at free throws, I shoot 1,000 free throws every morning. You do it 1,000 times a day for 30 years, guess what? You're going to be really good at free throws. These engineers are getting better and better and better. And you and I as mineral owners, we love it because the wells they drill next year are better than what I had last year. It's going to make more money for us in the long run.
One of the guests asked, how have you typically financed or capitalized your projects in the past? Why approaching private investors for this one?
I've always used private investors. Ever since I was 20 years old, I've always worked with high net worth investors. I realized a long time ago, here's how it works. And you probably know this from some of your own ventures. Mm-hmm. I go to a private equity group and they say, Troy, we'll give you $100 million to buy minerals. Okay. Well, here's the minerals I want to buy. We don't like those. We want you to buy over here, not there. We don't like Continental, buy here. Well, that's not how the model works. I don't care how the model works. We're telling you it's our $100 million. Here's how you do it. So all I've learned over 37 years of investment is when you hand the reins off to somebody who has no clue what they're doing just because they have money, it's a guaranteed failure. I have really rich clients come in and say, Troy, I'll buy into your foundation. It's 100 million. I'll put up 50 million. I want a cheaper price. I want to tell you where to buy and what to do. The answer is no. Well, I'm going to give you 50 million. I don't care if you give me 500 million. The answer is no. Here's why. In my world, when I go to 500 high net worth investors, I'm being very blunt, I just access myself to $500 million worth of capital. You're my bank. If I do a really good job, my bank expands because you give me referrals and you tell your friends and you invest for them. I do really bad, my bank shuts the door. In this case, because we're dealing with assets that have immediate cash flow, no risk and no cost or expenses, I get to look at my ability not only to buy minerals in Oklahoma, we've already analyzed 7 other basins. We'll be buying minerals in North Dakota, we'll buy minerals in Permian Basin, West Texas, the Eagle Ford, South Texas, the Haynesville, et cetera. Why does that matter? Every basin has different price components. We know there's about $250 million left of tier 1 minerals that we like in Oklahoma. We might buy those in the next 24 months. But we also know there's probably $1 billion to $2 billion in these other basins that are tier 1 we haven't even started with. So by having high net worth investors, I have you making more money, making investments, selling real estate, doing stocks, running your careers. You're always rejuvenating your liquidity and your cash flow. If I do a great job with my team, you'll be my partner the next 25 years. And I don't know if Eng told you or not, but we have our own private investor conference every year, and we do it for 2 reasons. I want my clients, Eng's clients, Eng to come to our conference, meet the other 200-300 clients that show up at the event. You talk about everything from real estate to crypto to minerals, et cetera. You exchange names. You go, look, either Troy's a liar, and after 3 days, we're going to hang him like a piñata and beat the stuffing out of him, or he's telling the truth. We really like the guy. We want to be his partners the next 10 or 20 years. The only reason we need high net worth investors today is we're running out of time. We did 82 million last year. By the end of March, in 2 weeks, we'll have done 125 million in the first 3 months of this year, because people have recognized the value in hard assets in a declining stock market, and real estate's getting a little dicey. I'm just telling you what I hear from my clients. I'm not the expert, right? But if we go to the market and we know there's minerals to be had, we don't have 2 years to go buy them at 50% discount. $125 oil is going to bring in every Tom, Dick, and flipper. Every dummy in the world is going to jump in and run the price up. We heard today from one of our landmen. We were buying minerals for 11 or 12,000 an acre. She got a call from a landowner and said, "Oh, I've already been offered 20,000 an acre because oil's at $120 a barrel." They're going to muddy the water, and we're going to be able to not buy minerals. They're not going to make economic sense. So I guess we've got 12 to 18 months, and then I'm going to put the brakes on and stop buying. We'll have $250, $400 million worth of minerals. We'll wait. Oil price will give us a tremendous return. I got other things we're going to go do, but we won't come back to minerals until it makes economic sense.
It sounds like Bitcoin mining. I started Bitcoin mining right, just perfect time, and I think there's a good year left in it in terms of getting into it.
Yeah.
I would not want to get into it when Bitcoin is way too high.
Yeah, it's really a tough business, Eng, in the fact that I hate to use the word timing, but really, as I see the pattern where it looks like the oil industry is kind of, the next time I hear that Russia and Saudi Arabia are thinking about flooding the market, we're going to gear up to buy because everybody's going to be crushed, right?
Mm-hmm.
The one thing all your listeners should understand is what makes the difference between the US and, let's say, Saudi Arabia, OPEC, and Russia. We're the only country that has private energy companies really that control most of the energy in the US. And we have public equity. We got to tell everybody in our financial statements what we do, how we drill, what we spend, et cetera. We got to borrow money at the bank. The bank is regulated by the federal government. So Saudi Arabia, Russia, OPEC, they get to look at our playbook and go, look, if we just flood the market for 60 days and the price drops, the reserves go down, the value goes down, the collateral goes down, the bank calls their note, stock goes down, they have no money to borrow. We can wipe the oil and gas industry out in 60 days. They've done it now 3 times. They did it in 2008, they did it in 2014, they did it again in 2020. Every 4 to 5 years, they're going to cut our legs off. What's the difference this time? The difference this time is it's going to be prolonged, not every 4 or 5 years, because our own internal regulations have run the capital off, which means we're not going to have the money to compete. What made Saudi Arabia, OPEC, and Russia upset, we went from being a consumer of 9 million barrels a day we imported to producing enough to make 9 million barrels inside the country. Then we started exporting excess oil. Then when we got to 13 million barrels, we actually started selling to their customers, and they said, we can't have that. So they cut our legs off. We were not going to be able to compete by selling oil to other countries because we need it for ourselves. So I think this time it won't be a 3 or 4 year before they chop our legs. It's going to be more like 4 to 7 years, but they will come at us again by flooding the market because we play by a different set of rules.
I think the whole geopolitical landscape has changed. Energy independence.
Yeah, you and I talked about that. That's yeah. I'm not vacationing in Ukraine or Georgia or like that anytime soon. Look, I want to be very serious, everybody. We don't want to make a profit at the expense of a war, and we sure don't want to make a profit at the expense of Ukrainians and that. But let me tell you what's really happening. If you look at what Iran had happen to them because of the sanctions, Russia's going to go through that. No matter how this war ends up, Russia has 4 to 8 million barrels a day. They're going to be sanctioned. So you take 4 million barrels out of a global market, even under sanctioned, or even if it's a short-term 2 or 3 year restriction, you just took 4 to 7% of global daily consumption out of the market. There's nobody that can replace. The reason why Saudi Arabia is saying no to Biden, not only do they not like him, they're saying no to Biden because they truly don't have it. I'll give you just a statistical numbering that'll blow your listeners away. So when the flood of oil came in March of 2020, we had nowhere to put the oil because the US has no storage facility. We got 45 days from the wellhead until all of our storage is full. We started shutting wells in after 45 days because we had nowhere to put it. So when you back the hose up all the way to the wellhead, you got to shut the well in, right? So we now know we're 45 days away from any disruption. We got to shut wells in. It kills the industry. Very, very dangerous, right? Here's the key point. During that 45 to 60 days, 1.2 billion barrels around the globe was produced, but not being consumed because we all got in lockdown because of COVID. They stored it from South Africa. I mean, if you had a swimming pool, they were trying to put oil in your swimming pool. They put it anywhere they could find it because there was nowhere to go. Every tanker, every storage facility, you name it, right? The reason why oil prices did not skyrocket the first 20 months after that particular event in 2020 is we had an extra 2 to 3 million barrels a day, not coming from the wellhead. We were pulling it out of that 1.2 billion barrels that sat there and got overstored during the shutdown because of COVID. So here we track along for 2 years. And I kept telling my partners, guys, we're missing 1.2 billion barrels out of daily supply that we need because we're taking it out of storage. When that storage runs out, which it did last September, I said, oil prices are going to rock. I predicted oil would close at $77.50. I missed it by $1.10. It was $75.90. I told my clients, oil is going to be over $100 a barrel in the first half of 2022. Had no idea about Russia. And the reason why is we no longer have enough oil. We have nothing. Think about it. 32 countries put in 62 million barrels of oil last week. They thought it was a great deal. You want to see how dumb this was? 62 million barrels, 32 countries. Guess what? That was 14 hours of global consumption. So people who buy oil took out of their oil supply, dumped it on the market for 14 hours. Now, when the oil prices or the oil supply starts coming back, they need to put the 62 million barrels back in supply, which means we're further in a deficit. It's like people borrowing on credit card to pay off a credit card at a higher interest rate. The day of reckoning is upon us. We are going to escalate to $150 to $200 a barrel. It cannot stay there because I'm going to stop driving my diesel truck when I have to have a proof of funds to pull into Exxon to fill up my car. I'm not going to buy my diesel. You're not going to buy those houses and carpet when you're having to pay 4 times the price. So there will be a day of reckoning, but that's probably 24 to 48 months out. In the meantime, those of us that own minerals are going to make a killing. I mean, it's not like I'm bragging. It's just timing. I mean, we're just very fortunate that we timed it right. That's it.
So speaking of timing, one of the guests asked, how long will these wells produce for? 25, 50 years?
25 to 50 years. Yeah, that's the nice part is that because of the way the wells come out of this really hard rock, once you create the fractures, you get that flush production, then those molecules just move out over a slow pace. So you might start off at 1,000 barrels a day, and in 5 years, you're down to 100 barrels a day, but you've already made your money back in profit. But that 100 barrels might 20 years out be down to 20 barrels a day. Again, the oil company. So you got to think about like Alaska. Alaska, when it first got drilled, had all these big wells. Alaska's still producing, still making a ton of money. They have lots of reserve, and it's 40 years old. Most of the minerals that were developed in the West Texas Permian Basin came online in 1910. Those minerals are still productive after 100 plus years. So what's nice about it is, so let's talk organic content. It's going to blow your mind. When you take and extract and squeeze every molecule of oil and gas from a section of land, which is 640 acres in the Anadarko Basin, to the north, the northern part where it first started to funnel in that canyon, it's about 50 million barrels of oil in place per square mile. When it comes down toward the Texas border, the big Grand Canyon gets skinnier and deeper. Now it's 1,300 foot thick. Now it's 250 million barrels per square mile, 5 times. The key to how much we get out, which is called recovery reserves, is based on technology and commodity price. So in the oil and gas industry, there's what they call peak oil theory. So some guy came up with back in the 70s, said, there's going to be a time when we peak out how much oil and gas comes from planet Earth. We're never going to get past peak oil because eventually we're not going to find any more oil and gas. It's all nonsense. His theory's been shredded because here's why. You pay me $400 a barrel, I'm going to have a rig in the North Sea. I'm going to have somebody in Africa. I'm going to have somebody in Latin America. They have what they call the Vaca Muerte field down in Argentina, which it needs $68 a barrel to break even, but it's massive reserves. Well, you pay me $400 a barrel, I'll be in Argentina next week. So it's just like cancer. If there was more money solving cancer than there is in oncology, cancer would be solved tomorrow, right? But it pays more money to not solve it, just kind of modify it. Now, I know that's a little on the personal note. I mean, I've had cancer, but the reality of it is we're all driven by success, but we're also driven by monetary benefits. In today's world, we're only drilling where oil can be drilled and found for $65 a barrel. Oil goes to $200 a barrel, we're going to find a lot more. How do I know that? In 2008, we had as much oil being produced in the US as we did in 1941. Watch my hands. 1941, 3.8 million barrels of oil. 35 years later, 1971, or 30 years later, 1971, we're at 10.2 million barrels a day because the economy grew, people grew, we found better oil and gas. From 1971 to 2008, we dropped back down to 3.85 million barrels a day. Oil was at $145 a barrel because we were running out. But at $145 a barrel, these oil companies said, we can experiment. Let's drill a bigger horizontal well. Let's put 20 million pounds of sand. Let's frack these wells. And guess what? They uncovered and unleashed the discovery how to make these wells produce. So from 2008 to 2013, okay, excuse me, 2019, we went from 3.8 million barrels a day, almost running out, to 13 million barrels a day, and we're the #1 oil producer. We did in 12 or 13 years what it took 30 years to do previously. Why is that? You pay me enough and I'll do it. I don't like airplanes. I'm not going to jump out with a parachute, but go, Troy, I'll give you $1 million to jump out. Adios, muchacho. I'm jumping. I hope I have a parachute on. But that's the way the economy works. You have enough incentive, you will discover a way. There is tons of oil and gas on this planet. It's just how much you're going to pay me to go get it. That's it.
That's great. I think there's obviously supply demand, and it's going to be more demand. And you mentioned that you did drilling sometimes. Like, how much of your company is investing in drilling?
We're the #1 investor in drilling. So like right now we polled our partners in at the beginning of the year in January. I said, look, it's going to be really hard to find working interest drilling opportunities this year because these major companies are sucking it all up. I said, we're going to create a list. Anybody who needs drilling this year, tell me how much you're going to need, when you think you're going to have your money, when you need to invest. We're going to create a list. We'll do first come, first serve. One doctor said, I need $1 million. I'll do 250,000 per quarter. One guy said, I need 100,000, 25,000 per quarter. We created the list and we started sending our land team. We have 45 landmen in Oklahoma looking for minerals, where they also run across open leases or people who might be in a well that they don't want to drill. They don't have the money, but they'll let us drill it. So we've started finding positions. We found, I think 2 or 3, Amanda knows, we found like $300,000 last week. I took 100,000. I offered 100,000 to 2 different partners. One partner got greedy, said, I'll take 200,000. I try to keep as much as I can, but I also don't want to be greedy because a lot of our clients are really desperately looking for tax write-offs. And the fact is, all the wells we've drilled in the last 3 years, they've all been very, very good wells. We've not drilled any dry holes. So we're all scraping, trying to find those drilling opportunities. So any of your listeners need to contact you and say, hey, look, Eng, can you help us find some drilling? Eng will tell us what you guys need. We'll help put together a list, put you on that priority list. I think we can find 25 million this year, but it's going to be hard. And when we find it, there's not going to be any time to go, well, let me think about it. We're going to have to scramble, because I can tell you right now, the oil companies have been cut off their lines of credit. Everybody thinks the oil companies are making more cash because oil prices are up, and that's true, except their bank said, your current line of credit's fixed. That extra cash, you're paying down your debt. So it's kind of like being in default with your bank and you find some extra income. They go, thank you very much. We'll just pay it against your debt. And you're like, hey, I was going to use that to expand. No, you're paying down your debt. So all this extra free cash flow is paying down debt. It's not adding to rigs. We're at about 620 drilling rigs. We might add another 75 drilling rigs, maybe 100 this year. We should add 400. It's not going to happen because everybody's constrained because the banks aren't going to lend them any more money. That means less drilling, less chance for you and I to find working interest. We're scrambling, but we're very, very picky. I mean, we're very picky. I'm not going to go invest in a well that I don't think is going to make me money. I mean, I'd rather pay my taxes. I know none of you want to hear that. I'm not into losing 67 cents to save 37. I mean, I did pass first grade on math. That doesn't work.
Did you ever drill on your own mineral rights?
We have had we've had a good fortune where in fact, the Paloma wells I was talking about earlier, we bought into the drilling, and I sent my landman and I said, hey, go find minerals in there. We can find any mineral. So I think we bought some minerals in both sections were part of that drilling. And I love to own the minerals in my own drilling. So let me give you simple math on 2 different equations your listeners might appreciate. When an oil company leases the minerals, let's say it's 2,000 an acre, the rule of thumb has always been the mineral's worth 4 times what they lease it for. So if Exxon will lease my minerals for 2,000, the mineral should be worth 8,000, right? That was the rule of thumb for years. Mm-hmm. Now it's exponentially a lot higher because why? Because now we know that the wells aren't going to have 1 or 2 wells. It's going to have 8 to 12 wells. So now it's more like a multiple of 8 or 10 times. So if you pay me 2,000, it's 16 to 20,000 per acre for the minerals. The same thing with working interest. If I own 1% working interest in a well, I'm going to have X as my value. If I own minerals in the same well, it might be worth 4 times that. Why? I pay no cost, no rehab, no reworking, no expenses. Mine is 100% net cash. By the time that well is drilled and eventually plugged and abandoned, I'm going to say 1% of minerals is worth 4 times interest in drilling. So what we do is drilling, We do it because of the tax write-off. We get a bigger chunk of the cash flow because we own a bigger piece, but in reality is we're investing in one well at a time. If I buy a mineral acre, I'm in every single well with one investment. I get one check and I'm in every single well drilled with my revenue. If I drill a successful well, we're about to experience this in the wells we drilled last year. They're about to drill 4 or 5 offset wells. We're going to get slapped with 4 $10 million bills at a time. And we either choke or we let Eng and his partners in to take the interest we can't afford. It's, I laugh because when I got in North Dakota back in 2010, we started buying small pieces with several majors. And I kept telling my partner, I said, for every dollar you write, you have $4 more because they're going to drill 4 more wells. So don't be a pig. Oh, I'll put $500,000 in. I said, well, that means you're ready for 2 million when they cash call? Oh, I can handle it. We got sometimes many as 19 well proposals on a Monday morning at $10 million per well. I'm like, we got to send out $5 million in cash calls in a week. So what I've learned in the 37 years is greedy hogs get slaughtered, smart hogs stand back to see how the first hogs get treated. I want to be a small participant with billion-dollar companies, but they have got $1 billion line of credit. We don't. So we're going to systematically buy working interest. We'll invite partners to participate with us. We'll manage it, but we're going to do it very, very small and at a modest pace because we do not want to get ourselves caught upside down. And the truth is, I don't want to drill the first well, and it's a great well, and then I can't afford the other 4. The whole reason I drill the first one is the next 4 should be lower risk and faster cash flow, right? So I don't want to load up on one and miss the other 4. So we're going to do it very slow, very modest.
When guests ask thoughts on the Keystone pipeline being stopped and what happens if it goes back online.
Okay, so you want to explain the Keystone or just answer the question?
Yeah, you can just answer it. Unfiltered if you want.
All right. So the truth of the matter is, here's the problem with the Keystone pipeline. There's not been a new U.S. refinery built since the 1950s. The refinery owners, the Koch brothers, decided all of my customers who were putting oil in my refinery were running out of oil. I got to find new customers. They went to Venezuela, South America, and they got oil that was much lower gravity, meaning it was more like asphalt, really thick, sludgy oil, not this beautiful West Texas oil that looked like a beer can, right? You had this nice, beautiful oil called West Texas Intermediate. So the refineries were retrofitted to process really heavy, sludgy oil. And that's what those refineries have been doing since the 1970s. Well, no one expected that we'd find such good quality oil in these shale plays. So the problem became, we've got so many barrels coming from Latin America and Venezuela going into our refineries. We were taking our 3.8 million barrels we were producing in 2008, and they were blending it. So every refinery tries to blend 35 gravity with 60 gravity to get to 42 degree gravity. The baseline for West Texas Intermediate oil is 42 degree gravity. The refinery then can process it into diesel, gasoline, byproducts, and synthetics. It's the perfect blend for maximum refinement, right? That's just the way it works. When we ran out of oil, they went to South America and Venezuela. Well, now those factories, which are heavily regulated, are geared to set up for heavy crude oil. When we started making shale discoveries in the late 1990s and started really booming in 2009 and 10, all of a sudden we've got 8 million barrels a day of 60 degree gravity gasoline looking oil. We don't have enough crummy oil to mix with the good oil to put in our refinery. So Koch brothers and the refinery says, we don't need your oil. So the US government in 2008 had a law in place since World War II called the Marshall Act, that we could not export oil to another country. They stopped the Marshall Act and start letting us export oil. Now we're taking away Saudi and Russia's customers, but it's only a little bit of time. Now we're at 3 million barrels a day. But think about the logic. The reason the Keystone was so important is it was going to bring tar sand oil at 28 degree gravity to mix with the 8 million barrels of beautiful shale oil to give us maximum refinement at our refineries. But if Obama and if Biden and those that don't want the fossil fuel industry to grow, if they kill the Keystone, there goes 800,000 barrels of oil we can mix with this beautiful oil. Guess what? We don't have anywhere to refine our oil. So what you see crazy, Saudi Arabia's coming in with Saudi oil, Russia's coming with Russian oil, and we got tankers going the other way with 3 million barrels of our beautiful oil because we didn't bring in the Keystone pipeline. It was killed because having Keystone helped grow the fossil fuel market in the US. This is all a political deal. It's about who loves oil, who loves solar panels and all that kind of good stuff. I'm not saying one is right over the other. I'm just saying why it failed. Now what you have is Biden running around the world saying, we want oil from anywhere. You want more crummy oil from Venezuela, who ran off 10 million of the citizens, than taking 800,000 barrels from Canada in a pipeline that's more safe than trucks. It's so we're in a situation, to answer the person that asked the questions, is they may not bring the pipeline back online because the people that underwrote it walked away from it. When Biden killed it, they said, we're done. We've been doing this for 10 years. We're out. It's financially killed. If they reacted it, it may take 5 or 10 years. We could use that really low gravity oil to help process our current oil. That also brings me to why we're in Oklahoma. Permian Basin is the Saudi Arabia of the United States. Unbelievable amount of reserves. Problem is, so many pipelines. So they are producing oil like crazy. You can't get a pipeline built because in order to build a pipeline, the producers have to guarantee how much oil is going to go through that line because they charge a tariff. Well, if their financial statements are horrible, which they have been for 3 years, they can't guarantee any financial credit of oil going that line. That means the pipeline builder can't get bank financing. There's going to be no pipelines built for the next 2 to 3 years. So what does that mean? Permian Basin, which was maximum production in 2019 before the crash, when they get to that maximum, that's all that's coming out of there. What I like about Oklahoma, we send all of our oil to Cushing, Oklahoma, the #1 storage facility in the United States. It was the only storage facility in the US that did not shut in 2020 because they couldn't take any more oil. They still had plenty of capacity. I like the state. I like the regulations. I like being next to the biggest storage facility. All their pipelines run to the Gulf of Mexico, which is exporting LNG to Asia and Europe. And guess what? Since Russia turned off the gas and Russia played with Europe's energy, all the Europeans are now saying, how do we get exported LNG from the United States? We're at 12.6 billion cubic feet a day. I bet that doubles in the next 4 to 5 years, which means what? Higher demand on gas, higher prices for gas. We got plenty. We're shipping to the coast. And guess where Oklahoma gas goes? Straight to the LNG facilities. How do I know that? I'm on the board of directors and the second largest owner in the second largest natural gas pipeline in the Gulf of Mexico called Connecticut Partners. I've owned it for 13 years. I know I look like a dumb redneck, but I've actually got around a little bit.
I appreciate that answer.
He's very careful not to go, we agree.
So it's just, I would imagine the foundation, is that price, trying to interpret someone's question, cost of ownership price at today's mineral price, or when
no, I got to tell you, we timed that right as well. When we negotiated, that was right after the first year. Our financial model is based on $60 and $70 oil, because the one thing we know is we can't change commodity. So we stay incredibly conservative on the financials because we're projecting $70 oil for the next 5 years in our base model for the foundation. But to answer your question from one of your members or your attendees, is that when we negotiated to buy that mineral package, what was it? $72 a barrel, and gas was at $4.40. If we had to negotiate today or last week's prices, instead of a $100 million package, it would have been 125 to 150 million if they even sold it at all. The reason the seller, the consortium, is selling it, they bought the minerals back before any wells were drilled, so it was totally high risk. They had the first well drilled to prove production. So all 276 square miles have a producing well on it. They made a lot of income the last 5 or 6 years, but they identified an asset they want to buy. They needed to sell this portfolio in order to buy that next asset. It's just like we're going to do. We may sell some minerals in 5 years. We're reshuffling our portfolio. They looked around and said, who's the only cash buyer? Eckard. Who's the only cash buyer that bought almost $100 million of minerals last year? Eckard. Who's the only one who has minerals in the exact same area? Eckard. Let's go to Eckard and see if they can afford to buy. Will they buy this huge portfolio? They really thought we'd buy only 25 or 30%. They didn't think we were big enough. By the time we ran our model, we ran our due diligence, we said, look, we love it. Let's come to a term that we agreed to. We hammered that out. And I said, that's conditional that we get to buy 100%. Okay, you guys know that's $100 million. You got to close in 90 days. I said, no problem, we got it. So the key is that we stood hard, back to the high net worth relationship. We stood hard by calling some of our biggest partners and said, we're going to commit to a $100 million transaction. It's 64 portfolios in one single investment. Comes with 363 wells from day one. It's going to have 1,500 to 2,000 wells. Are you in with us? Will you back us? And our client said, heck yeah, I normally put in 100,000. I'll put in $1 million. We've got clients put in $1 million, $5 million, $4 million. We have one partner right now looking at taking the last 10 to 15 million with us. So as Eng knows, it's been off the chart. I've never seen anything like it before, but I think our partners get that we have picked the highest quality minerals with the best activation and cash flow with the largest companies. And by the relationship between you and our as new clients or Eng's new clients and our old clients, it's just aggregation of strength of capital by us all coming together, entering the mineral market by saying, look, if we all join together at the hip, we're a force that can't be reckoned with. So that's what's making life so good for us. We're buying the best minerals because we've aggregated our capital.
Yeah, I love the economies of scale.
That's it, economy scale.
Yeah, one guest asks, is the Mineralize producing income based on the already existing wells, correct?
Yeah, so in our model, we show the cash flow year one only on the income from the single wells in all 276 square miles. Then what we calculate is wells that have been permitted, we know are being drilled. So since we put the project under contract, 8% of the portfolio has now had multiple wells permitted, being drilled, or scheduled to be drilled. So already 8%. We calculated about a 11% rate of return on average, the first 5 years, assuming no activation, no new wells, et cetera. Now that we see we have 8% of the portfolio with new wells and permits, I think we're looking at more like a 15 to 25% rate of return. And you kind of seen some of our models in. It has to do with timing and number of wells. But what's happening is where the sections of minerals that we're buying happens to be where the highest level of infrastructure is. So these crews move down the gravel road and they go, here's a pad site, here's a pad site. They've already got electricity, water wells, utilities, et cetera. So we wanted to be in the core of the heaviest density of activation because of that infrastructure. And that is why we're seeing so many of our sections being permitted with 4, 6, 8 wells, because the oil companies are saying every well we drill on a multiple well site, we're saving $500,000 to $2 million per well because we don't have to build the gravel, the pit, the tanks, the electricity. And what these companies want, they want every dollar drilling a well, producing oil, not in electrical lines and pad sites and gravel roads. So that's why we're seeing such activity on our minerals. And remember, folks, I want to remind y'all, I've been doing this for 37 years. This is not my first rodeo. So I saw this exact same thing in North Dakota in the Bakken trend in 2014 when it had a downturn, and I owned 300 wells. And when they reactivated, this is the way their pattern was. I looked at that example and said, this is what's going to happen in Oklahoma. And they've done exactly the same thing. So it's because of experience, which has led me to be so far ahead of everybody else in ascertaining what's going to happen in the Anadarko Basin.
There's a few more questions. I think some of them pertain to the investment. We're going to save those for next week.
He says, don't steal my thunder.
I should get a standing pad. I'm like, my feet hurts. I appreciate it, Troy.
No problem. Eng, let me tell you two things. I'm always honored to be with you. I love the way you and I work together and talk. I think we've got a long relationship ahead of us. For those of you that are listening, look, this guy's a great guy. From everything I can tell, he's absolutely one of the smartest guys we work with. We're here just as a resource. If you need us, let us know. Eng will let us know what we can do. Hopefully, whether you do anything with our company, with Eng, whatever, just keep in mind, this entire economic scenario that we're in is going to be based on energy. So our stocks, our real estate, our businesses, crypto with the electricity, man, we got to have cheap energy. So I'm hoping that we make some big rebounds in production and supply just to help our economy. But in the meantime, as an investor, to be savvy, we might want to look at what's moving in the right direction to help us offset or balance our portfolio. And that's why I think so many of my big clients are loading up on minerals. They're trying to offset what they see coming in stagflation, et cetera. So I'll leave it with Eng, but thank you everybody for having me tonight. I really appreciate it. My wife's got a bowl of ice cream waiting on me. I don't think it's melted yet, but I'm definitely going to tear into it. I'm a little fat Texas guy, so I like my ice cream late at night. Eng, you need anything else from me, you let me know, let Amanda know, but so grateful for you guys letting us on with you. I appreciate it.
Thanks, everybody. And thanks to the 26 people who are still here. Stayed 2 hours.
Hardcore.
Thanks, Troy, again.
No
I'll see you next week.
All right. Thanks, guys. We'll see you later. Take care.
Good night, guys.